You know, the thing about market tops, usually they're loud. You get the magazine covers, the cab driver giving you stock tips, the euphoria. That's how it usually ends. But this move to $5,500, it's quiet. It's uncomfortably quiet. I was looking at the intraday chart from January 29th. That morning, we spiked to $5,594. And what stood out wasn't the price. It was the quality of the buying. There was no hesitation. It didn't look like retail traders chasing a breakout. It looked mechanical, like a machine with a mandate to acquire at any cost, regardless of the price tag. And that is what worries me. Because when you see gold, an asset that usually moves like a glacier, suddenly behaving like a tech stock, your first instinct is to say bubble. You want to short it. You want to fade the move because that's what a rational market would do. But then you look at who is actually panicking. It's not the guys on Reddit. It's the institutions. You have Wells Fargo. You have JP Morgan. These massive, slow-moving ships that have been skeptical of gold for years, suddenly, literally in the last 2 weeks, scrambling to revise their targets upward. JP Morgan is talking about $6,300 now. Wells Fargo is right there with them. Why? Why now? Why didn't they see this at $4,000? They're chasing. That's the only word for it. They are chasing a market that has already left them behind. And the reason they are chasing isn't because they want to own gold at all-time highs. Nobody wants to buy the top. They are buying because a specific mechanism in the global collateral markets just broke. There is a ratio. It's deep in the central bank data, buried in the reserve allocation reports from emerging markets that crossed a red line in late 2025. It's the ratio of unencumbered gold to sovereign debt. And once that line was crossed, the price of gold stopped being about inflation. It stopped being about interest rates. It became about solvency.
So if you're looking at $5,500 and thinking, I missed it or it's too expensive, you are looking at the wrong metric. The price is just a symptom. The disease is something else entirely. And if the big banks are right, if this chase to $6,000 is actually a forced liquidation of paper assets, then we aren't at the end of the cycle, we're at the point of no return. Let me walk you through the numbers that nobody else is looking at. So let's look at who is actually exposed here, because that's the first thing you have to ask when the rules stop working. Who is on the wrong side of the trade? For the last 3 years, the narrative, the smart narrative on Wall Street, was that as soon as real rates stayed positive, gold was dead money. That was the playbook. You hold dollars, you hold treasuries, you get your 4 or 5%, and you sleep at night. Gold doesn't pay a dividend, it doesn't pay interest, so why hold it when cash is king? That logic works right up until the moment it doesn't. And that moment was the $5,500 breach. I was reading the Wells Fargo note from earlier this month, the one where they raised their target range to $6,100 to $6,300. And you have to read between the lines of these things. They don't just come out and say we were wrong. They say things like reassessing structural drivers or adjusting for persistent volatility. But look at the timing. They issued that guidance after the breakout. Think about that. These are the guys with the best models in the world. They have armies of analysts, and they are reacting to the price action, not predicting it. That tells you that the institutional money, the pension funds, the endowments, the classic 60/40th portfolios, they are underweight. They don't have enough exposure. And this is where the math gets messy.
If you are a fund manager and you are benchmarking against inflation or against a global index, and gold, which is a distinct asset class, rips 20% or 30% in a quarter, you have a problem. You are now underperforming your benchmark because you didn't own the one thing that went up. So what do? You don't sell. You have to buy. You have to chase it to get your allocation back in line. It's a forced feedback loop. And here is the contradiction that nobody is talking about. Look at the dollar index, DXY. It's not crashing. It's actually holding up relatively well. Normally, when the dollar is strong, gold gets crushed. That's the inverse correlation we've all been taught since Econ 101. Dollar up, gold down. But right now, they are decoupling. We are seeing gold hit all-time highs while the dollar is still relatively expensive. That shouldn't be happening. It's like seeing rain fall from a clear blue sky. It violates the basic physics of the market we grew up with. So why is it happening? I think the answer lies in a number that JP Morgan flagged. They mentioned central bank buying is still pacing for something like 800 tons this year. Now, 800 tons is just a number. It sounds big, but let's contextualize it. Back in the 2010s, central banks were net sellers. They were dumping gold. They wanted dollars. They wanted euros. Now, they are buying 800 tons a year at record prices. They're buying at $5,000. They're buying at $5,500. This isn't a trade for them. A central bank doesn't trade. They accumulate. They're swapping paper for metal because they see a settlement risk in the paper market. And this is where most people get trapped. They look at the chart and say, well, it's gone up too much. It has to pull back. I'll buy the dip at $4,800. I hear that a lot. I'll wait for $4,800. But what if the buyers at $5,500 aren't price sensitive?
If the buyer is the People's Bank of China or the Central Bank of Poland or a sovereign wealth fund in the Middle East, they don't care if they pay $5,500 or $5,550. They have a quota to fill. They have to diversify X billion dollars out of treasuries and into hard assets by the end of the fiscal year. They are just hitting the buy button until the order is filled. That kind of buying doesn't give you a dip. It just eats the order book. It chews through every sell order until the price jumps to the next level. That's why we saw that vertical move to $5,594. It was a liquidity vacuum. And honestly, it scares me a little because it means the price isn't being set by supply and demand in the traditional sense. It's being set by desperation. I want to show you something else. It's a bit technical, but stay with me because this is the smoking gun. Look at the open interest in the futures market versus the physical delivery requests. Usually the futures market, the paper gold, dwarfs the physical market. People trade contracts. They don't want the actual bars. But in January, we saw a spike in delivery requests. People, big entities, wanted the metal. They didn't want the cash settlement. They wanted the bars in the vault. When you see that, when you see the paper market start to bleed into the physical market, that's when you know trust is breaking down. People don't trust the contract anymore. They want the asset. And that brings me back to the $6,000 number. Everyone is fixated on $6,000 like it's a finish line. Oh, if it hits $6,000, I'll sell. But if Wells Fargo is right, if we are entering a super cycle driven by this structural shift in reserves, $6,000 isn't the ceiling. It's just the next psychological hurdle. Think about it. Adjusted for inflation, real inflation, not the CPI print they give us on TV, but the actual debasement of purchasing power since 1980, gold isn't even at an all-time high yet. It sounds crazy to say that when we are staring at $5,500. But in 1980 terms, we are still cheap.
And that's the trap. The trap is thinking that because the number is big, the value is high. But what if the number is just getting bigger because the denominator, the currency we are measuring it in, is getting smaller? That's a different conversation, and it's the one the banks are having behind closed doors. They aren't betting on gold. They're betting against the stability of the system that prices it. So, we have a market where the biggest players are underallocated. We have a buyer, central banks, who is price insensitive and driven by political safety, not profit. And we have a retail public that's mostly watching from the sidelines, scared to buy the top. That is a recipe for a melt up. A melt up is nasty. It's not a steady climb, it's violent. You get these massive spikes and then sharp, terrifying drop-offs that shake everyone out, and then it rips higher again. We saw a preview of that last week. The drop from $5,594 down to the $5,000 area, that shook a lot of people out. It looked like the top, but then it stopped. It didn't crash. It stabilized, and now it's creeping back up. That stabilization is the key. It tells you there is a floor. There is a bid sitting there just waiting to catch it. And if that floor holds, if $5,000 is the new $2,000, then the path to $6,000 is a lot shorter than you think. But there is something else happening, something that isn't on the charts at all. It's behavioral. I was talking to a dealer friend of mine. guy who runs a bullion desk, and he said the phone calls have changed. 2 years ago, it was people buying coins, preppers, people worried about the end of the world. Now, it's family offices. It's wealth managers asking about storage fees for allocated bars in Zurich or Singapore. The client base has shifted. It's gone from insurance to capital preservation. And that shift changes the velocity of money. Because when a family office buys, they don't buy an ounce, they buy tonnage. And once they buy it, they lock it away. It comes off the market. It doesn't circulate.
So the available float, the amount of gold actually available to buy, is shrinking at the exact moment the demand is spiking. Supply shock, demand shock, monetary debasement. It's the perfect storm. I hate that phrase, perfect storm. It's such a cliche. But I don't know what else to call it. But listen, I'm not here to tell you it's a straight line up. It never is. There is a scenario where this whole thing rolls over. There is a specific signal I'm watching that would tell me I'm wrong, that would tell me the banks are wrong, the central banks are done, and we are about to crash back to $4,000. And nobody's looking at it. Everyone is looking at the Fed, everyone is looking at inflation data, but the real signal is coming from somewhere else entirely. It's coming from the energy market. And if you miss this correlation, if you don't understand how energy prices act as a governor on gold, you could get hurt. Because right now, energy is telling a very different story than gold. And one of them is lying. I want to dig into that mechanism in a second. Because if you understand the relationship between oil, energy, and gold, the panic to $6,000 makes a lot more sense. But it also exposes the biggest risk in the trade. The risk isn't that gold falls. The risk is that the system responds to $6,000 gold in a way that none of us are prepared for. Let's talk about the mechanism. See, normally gold and energy dance together. It takes diesel to run the excavators. It takes electricity to refine the ore. Energy is the base cost of extraction. So when oil goes up, gold has a floor. When oil crashes, gold usually softens because the cost of production drops and inflationary pressure eases. That's the mechanism we've traded for 40 years. But look at the last 6 months. Oil has been choppy, mostly range-bound. Natural gas is in the basement. Energy is not screaming inflation, and yet gold is ripping.
This divergence, where gold decouples from its energy input costs, is the signal that everyone is ignoring. It tells you that the price of gold isn't being driven by commodity inflation anymore. It's being driven by monetary anxiety. When gold rises without energy rising, it means the market isn't hedging against the cost of living. It's hedging against the credibility of the currency itself. And that is a much, much more dangerous trade. This is the mechanism people are missing. Gold is transitioning from a commodity trade to a currency trade. When you treat gold like a commodity, like copper or soybeans, you look at supply and demand. You look at mine output versus jewelry demand. And if you look at those numbers right now, $5,500 makes absolutely no sense. Jewelry demand in India is softening. The consumer is tapped out. If gold were just a commodity, we should be trading at $4,000, maybe lower. But when you treat gold as a currency, specifically the only currency with no counterparty risk, the valuation model changes completely. You stop comparing it to the cost of mining and start comparing it to the volume of sovereign debt that needs to be refinanced. And that's the number that keeps me up at night. The global debt pile is so large now that central banks can't let interest rates stay high enough to offer a real return. If they do, the interest payments consume the entire budget. So they are forced, mathematically forced, to keep rates below the real rate of inflation. This is called financial repression. It's a polite term for slowly stealing your purchasing power to pay off government debt. And the big money knows this. I was speaking with a fund manager in London last week, a guy who manages a massive fixed income portfolio, and he told me something that stuck. He said, "I don't own gold because I think it's going to $6,000. I own it because I can't own bonds anymore." Think about the gravity of that statement. The bond market is the bedrock of the global financial system. It's supposed to be the risk-free return. If the guys who run the bond market are defecting to gold, the plumbing is leaking. They are using gold as a substitute for treasury bonds. That is the structural shift.
And that explains the panic. If gold is replacing bonds as the Tier 1 collateral asset, then there isn't enough gold in the world at $5,500 to satisfy the demand. To match the liquidity of the bond market, gold would need to be multiples higher. That's why you see these air pockets where the price jumps $100 in a day. It's a collateral shortage. But here's the thing. This is the part where I have to be honest with you. This is the part where I have to tell you what could kill this trade. Because if I sit here and tell you it's only going up, I'm lying to you. I'm selling you a dream, and I don't want to do that. So here is what would invalidate this entire thesis. If the Federal Reserve or the ECB or whoever manages to pull off the impossible, if they manage to get inflation down to 2% and keep it there without causing a recession and without breaking the banking system, then gold at $5,500 is wildly overpriced. If we enter a period of Goldilocks growth, stable prices, moderate growth, positive real yields on cash, then there's no reason to hold a pet rock that pays no interest. If I see the 10-year Treasury yield stabilize at 4% while inflation drops to 2%, giving us a real, honest 2% return on risk-free cash, I will sell my gold. I will dump it. Because in that world, the dollar is king, and gold is just a shiny doorstop. That is the risk. The risk is that the system actually works. The risk is that the central bankers are smarter than we think, and they can navigate this debt trap without debasing the currency. If they pull that off, gold goes back to $3,000, maybe lower. But looking at the actions of the central banks themselves, I don't think they believe they can pull it off. If they believed in the soft landing, why are they buying gold at record highs? Why is China dumping treasuries? Why is Poland stacking bars? Actions speak louder than press conferences. And this brings me to the behavioral signal that nobody is watching. It's not on the terminal, it's in the streets.
Usually at a market top, you see lines around the block at the coin shops. You see "We buy gold" signs everywhere, flipping to "We sell gold." You see your taxi driver talking about mining stocks. We aren't seeing that. Retail interest, Google searches for "buy gold," traffic to bullion dealer websites is actually surprisingly low. It's elevated, sure, but it's nowhere near the mania we saw in 2011 or 2020. The public isn't in this trade yet. This rally has been driven almost entirely by official sector buying, central banks, and managed money, hedge funds. The mom-and-pop investors haven't even arrived. That is terrifyingly bullish. Because if gold can hit $5,500 without the public, what happens when the public finally wakes up? What happens when the average person realizes their savings account is losing value and they try to buy a few ounces? There is no inventory for them. The central banks have sucked it all up. So you have this massive pool of potential demand, millions of retail investors sitting on the sidelines, and you have a shrinking pool of supply. When those two things collide, price discovery breaks. You get a gap up. You wake up one morning and the price isn't $5,600, it's $6,200, and there are no sellers in between. But, and there is always a but, we have to be careful here, because when things gap up like that, the volatility cuts both ways. We are entering a phase where the market is fragile, it's thin. Because the sellers have disappeared, a small amount of selling can drop the price $200 in an hour. We saw that flash crash last week. That wasn't a change in fundamentals, that was a liquidity air pocket. So if you are buying here, if you are chasing $6,000, you have to understand the game you're playing. You aren't investing. You are insuring yourself against a fire. And insurance is expensive when the house is already smoking. We are standing at a fork in the road. Path 1, the soft landing narrative holds. The economy stabilizes, the dollar strengthens, the central banks stop buying. In that world, gold crashes, it resets, and everyone who bought above $5,000 looks foolish for a few years.
Path 2. The debt trap snaps shut. The central banks realize they can't stop printing. The panic buying accelerates because there are no other safe assets left. In that world, $5,500 is a footnote. In that world, We are heading for a repricing of everything. The scary part? We might not get a clear signal which path we are on until it's too late to switch lanes. But there is one specific thing, one very subtle change in the futures market structure that I'm watching to tell me which way the wind is blowing. It involves the Comex warehouses, because right now, the warehouses claim they have the gold. They show the inventory reports. But if you look closely at the eligible versus registered category, the numbers are getting tight, dangerously tight. Let me explain why that little accounting detail could trigger the next $500 move. Part 3. So here is the accounting detail that matters. In the Comex vaults, there are two categories of gold, eligible and registered. Most people just look at the total number and think, oh, there's plenty of gold. But that's a mistake. Eligible just means the gold meets the purity standards and is sitting in the vault. It doesn't mean it's for sale. It belongs to someone, a bank, a fund, a private investor. It is private property. It is not available to settle a trade unless the owner decides to sign a warrant and move it. Registered is the gold that is actually available for delivery against futures contracts. That is the dealer inventory. That is the float. And that pile, the registered category, has been bleeding. We are seeing a migration from eligible to registered. The owners are taking their metal off the market. They are effectively saying, I'm not a seller at this price. I'm holding. When you have open interests, the paper bets, that is hundreds of times larger than the registered inventory, you have the recipe for a squeeze. If even a small percentage of those paper holders stand for delivery, the registered stocks vanish. And when that happens, the price doesn't just go up, it dislocates. You get what we call backwardation, where the spot price trades higher than the future price, because people are desperate for the metal now.
That is the mechanism that takes us from $5,500 to $6,000 in a heartbeat. It's not about inflation. It's about a delivery failure. So here is how I am playing this. And more importantly, here is how I am protecting myself, because this is dangerous territory. There are two scenarios I am mapping out for the next 6 months. Scenario 1 is the squeeze. The central banks keep buying, the registered inventory hits critical lows, and the shorts, the banks that sold paper gold, are forced to cover. In this world, we blow through $6,000 and we probably don't stop until $6,500. This is the melt-up. If this happens, you do not want to be short and you do not want to be in cash. Scenario 2 is the liquidity event. This is the one nobody wants to talk about. This is 2008. If the Fed keeps rates high too long and something breaks, real estate, corporate debt, the shadow banking system, we get a deflationary bust. In a liquidity crisis, everything gets sold. People sell gold not because they want to, but because they have to. They need dollars to pay margin calls. If scenario 2 happens, gold could flush. We could see $5,500 turn into $4,800 or $4,500 in a week. That is why I am doing two very specific things right now. First, I am not using leverage. None. Zero. Buying gold on margin right now is suicide. The volatility is too high. You could be right on the thesis. Gold goes to $10,000 eventually, but get wiped out on a Tuesday morning because of a $300 swing. I am only holding what I own outright. Second, I am watching the spread between the paper price and the physical price. If I see premiums on coins and bars start to blow out, if the spot price is $5,500 but you can't buy a coin for less than $6,000, that is the signal. That tells me the paper market is broken and the physical market is the real price. I'm not celebrating this rally. I'm not high-fiving anyone about $5,500 gold. High gold prices are a symptom of a sick system. It means the other assets are failing. But I'm not fighting it either.
The trend is up. The buyers are sovereign states. The sellers are running out of inventory. So, am I chasing $6,000? No, I'm already positioned. I'm sitting on my hands. But if you are on the sidelines waiting for a correction to get in, you have to ask yourself if that correction is ever coming.
Because in a market driven by fear rather than greed, the dip buyers are aggressive. Every time it drops, a central bank steps in. We are in a new era. The old correlations are dead. And if you are waiting for the old rules to come back, you might be waiting a long time. There is one last thing you need to ask yourself before you make a move, and it's the only question that really matters.